Hello, welcome back. Here is Ali. I hope you're doing well, enjoying your time. We're going to start Module 9. In Module 8, we talk about capital budgeting, and I introduce several techniques or tools which you can use to measure different projects. So we talk about NPV, IRR, MIRR, and payback period during Module 8. In that module, we assume the cash flows are given. So based on the given cash flow, we use those measures to decide regarding investing in a project or not. In this module, I'm going to show you how actually we estimate the cash flow for any project. So I will show you different ways or methods which we can use to calculate the cash flows for each project. So let's start our module 9. So in this lesson, first we'll talk about the cash flow a little bit. I'm just going to make sure that we distinguish between the net profit, net income, and the cash flow. And then we'll talk about how we can find or how we can decide whether a specific payments or a specific money you pay or receive are cash flows. And we'll talk about what is cash flow, what is not cash flow. So let's start our first lesson from module 9. So when it comes to cash flows, again, you have to be careful. The concept is different than the net income. So we are in the world of finance, we are in the world of investment, and here we are more concerned about the actual cash. We learn in accounting courses that when it comes to the net income, we go with the expenses. And when we talk about expenses, we include some type of expenses which they don't have any connection with cash. For example, depreciation expense is very common type of expense, which is kind of non-cash expense. It's not the actual cash payment, but due to some accounting standards and rules, and also for tax purposes, we include depreciation. Same for revenues. Sometimes actually when we talk about the revenues, some part of the revenues you make are non-cash. So you don't receive actual cash, but you record them as the revenue. So as we argue here, the argument here is we need to focus on the cash flows. So the actual cash inflow whenever you receive the money and the actual cash outflow when you pay actually for the cash flow. So in this lesson, and I'm going to show you how actually we calculate or measure the cash flows. But before going there, we need to know that what items are considered as a cash flow, what items are not considered cash flow. One of the major notes here is when you look at the project, you have just to look at the incremental cash flow. So what is incremental? You want to see that what is the cash flow with the project and what is the cash flow without the project. And the difference should be allocated to that specific project. So these type of cash flows are called incremental. So when you accept a project, when you are working a project, what happens to your total cash flow? So any changes which is due to that project you accepted or you're working on, it's called incremental cash flow. And for sure, these incremental cash flows are relevant cash flows, and you have to include in your calculation. So those cash flows which they're not changing, you shouldn't be including in your calculation. For example, you start to work in one of your offices. So you were paying $1,000 rent for this office. So this is a type of expense which is not changing because of starting a new project using that office. So the $1,000, it's already been there. You have been paying $1,000. It doesn't matter you're working in that office, you are actually using that office or not. You have to pay. So that's not incremental cash flow. But if you want just to use the place as an office and you have to just buy some new furniture, for example, or some new equipment. So those equipments or furnitures are just for this specific project or work you are going to do. So those are considered as incremental cash flow. So the question you can ask yourself here is, would this cash flow still exist if the project didn't exist? Now, if the answer to this question is no, you should include this cash flow in your analysis. If the answer is yes, so it doesn't matter you had this project or not, in this case, do not include in your calculation. So we call that irrelevant cost. That's the irrelevant cost. So don't include the cash flows for the project analysis. So to make it clear regarding identifying cash flows, we are going to move step by step. Just I'm going to show you what type of cash flows you need to include, what cash flows you shouldn't include when it comes to project analysis. So I'm going one by one just to make it clear, and I just name which one you need to include, which one you don't need. Let's start with the general term, which is called indirect effect. So there are some revenues or expenses which are not directly affected by the project. However, there are some indirect effects. For example, you're launching a new product, and let's say you're talking about you are in the healthcare and the kind of hygiene product you produce. So you have the toothpaste. You are selling toothpaste, you're producing toothpaste, and now you are launching a new line, product line for the brush. So for the toothbrush, you are actually launching a new line. So what's happening here? There is a very high chance that this new product line of the toothbrush is also affect on the number of units that you're selling for the toothpaste. Why? Because people, they come to buy the toothbrush, they also buy the toothpaste as well. So what happens in this case? In this case, it impacts positively on your sales for the toothpaste. So that's the indirect effect. So should we include this indirect effect on our revenue? And the answer here is yes. So in this case, we have several terms which you need to know. One is called externalities. Externalities, if you hear this kind of fancy term, is same as the indirect effect. Externalities, it means there are some other factors which are not directly affected or directly associated actually with the project. However, it impacts on the outcome of another project or another product, which you have to include the impact on your calculation. The negative, if for example you're launching a new product which negatively impact on the sale or the profit of the other products, it's called cannibalization. Cannibalization, it means the impact is negative. So should we include this impact? Yes. Always you need to include the indirect effect on the project cash flow estimation. So the answer here is yes, indirect effect always. Another cash flow which you should consider is the sunk cost. So maybe you say, what is the sunk cost? So those are the costs which are not associated directly with the project. These already happened sometime in the past. For example, last year you paid $10,000 to renovate the building, for example. Now you decide just to run a new project using this building. The $1,000 you spent last year, that's the sunk cost. So it has nothing to do with the current project. Should we include the sunk cost? The answer is no. Never include the sunk cost in your project cash flow estimation. Those are gone. You cannot recover those costs. Those costs have nothing to do with the current project. Another type of cost which you have to consider is called opportunity cost. So now you are listening to this video. You could do tons of other stuff. You could maybe play with your phone. You could maybe just take a nap. So that's the opportunity cost. When you are involved in one activity, you are missing some other activities. And for sure, the time is kind of valuable. So you cannot do several things at the time. So that's the meaning of the opportunity cost. Let's say you have $1,000. When you're investing this $1,000 in a specific project, it means you are ignoring all the rest. You are missing all other opportunities. That's the meaning of the opportunity cost. When you are engaged in a specific project, when you are spending your money on that, when you are spending your time on that, that's the example of opportunity cost. You could do tons of other stuff. So should we include the opportunity cost in our cash flow estimation? And the answer is yes, include the opportunity cost. Also, there are some other costs which are called shutdown costs or shutdown cash flows. For example, you are buying equipment for a specific project. You might use this for 2 years or 3 years. After the project is over, you don't need that equipment anymore. But you can sell in the market and you can earn some cash. So the value which you estimate to sell this specific machine or equipment is called salvage value. In some sources, it's called a residual value. Should we include this residual salvage value in your calculation? And the answer is yes. We should include the shutdown cash flows, such as the residual salvage value, in our calculation. Now, we have some other type of cash flows and some other notes which you have to include and you have to consider. One of the major one is the working capital, which I'm going to talk about that in more details. So net working capital is one of those actually cash flows which for sure you have to include in your project and the cash flow estimation. But what does it mean? Very simply, just in a simple words, the working capital, that's your investment in current assets. If you hear the term net working capital, that's the current assets minus current liabilities. So what does it mean? When you are actually investing in a project, most of times you need to invest on current assets. So it impacts on your current assets, also it impacts on current liabilities. So maybe you need to buy more inventory, maybe you need to actually have higher level of prepaid expenses or higher level of liabilities, current liabilities. So generally speaking, it impacts on your working capital. So how we calculate the net working capital? As I mentioned, the net working capital, that's your current assets minus current liabilities. So that's very simple. However, we are not concerned just about the working capital. We are more concerned about the changes in the net working capital. That's the major part in cash flow estimation. Here you have to be careful. The working capital over time is changing. Okay, if it's going up, it means you are investing in net working capital. So the investment is cash outflow. So any increase in net working capital, that's a cash outflow. Any decrease in net working capital is cash inflow. And for sure, you can look at the components of the net working capital to decide whether the cash flow is going up or down. What are the components? Current assets and current liabilities. Now, if you are investing on current assets, for example, you're buying more inventory, is it cash outflow or inflow? For sure, that's a cash outflow. So when you're investing on current assets, when it's going up, that's the cash outflow. Here you have to be careful because you're talking from the cash perspective. For example, if you're buying inventory, yes, the inventory is going up. However, what happens to the cash? The cash is going down. So any increase in any items of current assets, that's a cash outflow. And for sure, we are excluding cash. We're talking about non-cash current assets, such as inventory, such as prepaid expense, such as accounts receivable. The opposite case can happen when the current assets are going down. For example, you're selling your inventory. The inventory is going down, but from the cash perspective, that's a cash inflow. So any decrease in the current asset, that's the cash inflow. Again, be careful, you're in the shoes of the cash. You're talking from the cash perspective. What about the current liabilities? The opposite case can happen for current liabilities. If the current liabilities are going up, For example, accounts payable is going up. It means you're saving, you're keeping, you're holding back the cash. So it's good from the cash perspective. So any increase in current liabilities should be cash inflow. And the opposite case also can happen for the current liabilities. Any decrease or reduction in current liabilities cash outflow. For example, when you're paying off your debt, your current liabilities, or your accounts payable, when you're paying back the accounts payable, what's happening here? You have to pay out of your pocket. That's a cash outflow. So make sure you consider it as a cash outflow. So again, be careful. Net working capital is important, but the most important part of that is the changes in net working capital. So any changes in net working capital can impact on the cash flow positively or negatively. One of the major mistakes which I've seen in many assignments, and usually students are making, that is including financing costs in their cash flow estimation. Now, we have to deal with that in a separate step. So when you estimate or calculate the cash flow, we ignore the way the project is financed. We don't care how the project is financed in the cash flow estimation. So when you calculate the total cash flow from operation, the working capital, the other type of cash flows, we don't care how that actually the project is financed. So we are ignoring how the project is financed. So we just look at the cash flow. Now, does it matter how the project is financed? For sure, it matters. It impacts on the cost of financing. It impacts in the cost of capital. Maybe say, Ali, how we measure or calculate the cost of capital. So we are going to talk about that in separate module. So when it comes to cost of capital, we'll talk about WACC and how we calculate the WACC. But for now, we're talking about the cash flow estimation. For the just cash flow estimation, we are ignoring the financing decisions. We are just looking at the investment decisions. We are just looking at the cash flows which are generated from the project. Now, we talk about the net working capital. There are two other major sources of the cash flow which we have to consider. One is the cash flow from operation, which we'll talk in the next lesson, same module, and also the investment in the plant and equipment, which is called CapEx or capital expenditures. All these three components together, they make the cash flow of the project, and based on this, we estimate the profitability of a project. So that's it for today. The next lesson, I will talk about operating cash flow, which is, I would say, the core part of the cash flow. It's very important because the major source of the cash usually comes from the operating cash flows or cash flow from operations. Thank you very much. Have a wonderful day. Here is Ali Talabi. Talk to you soon.